What's up, everyone? In this video, we're going to be talking about a father-son duo that is plowing over $500 million into this stock right now. It's crazy. We're not going to waste any time. So the stock we're talking about today is Carvana. I'm sure you've heard of this company before, especially over the past couple of years. They've been exploding, and they had these cool like car vending machine type things that allow you to buy and sell cars, and it's been booming, right? But here's the thing. Carvana as a company has actually been struggling quite a bit in multiple different areas. Their stock price over the past couple of years has done very, very well. So it had lows of around $8 back in 2017 and highs of $376 back in August of 2021. Since then, the stock has fell so much, and now it's all the way back down to 55. And there are some pretty bad things that are going on with Carvana right now. So there's multiple different parts of the problem. But basically, what a lot of Carvana customers have been experiencing are severe delays in getting their car's title. So for example, let's say you buy a car from Carvana, it can take multiple months just to get the title to that vehicle, and that's a giant problem because you can't legally prove that you own that vehicle, so you can't get insurance on it, and it just delays a lot of other things, and you technically can't legally be operating the vehicle until you have the title, and it's been just a giant problem in many different states. Florida, Texas, North Carolina, Pennsylvania, it's been a giant problem, and it's not looking good for them because like if you buy a car and you spend tens of thousands of dollars doing so, and then you're having a big problem getting your title, you can't even buy insurance for your car. It's bad. It's been hurting a lot of people, so that's one of their main problems. Another thing is they've been accused of doing some shady things in terms of what cars they're actually buying and selling. So Carvana does do a lot of buying of cars from rental car companies, and these rental car companies don't technically report damage to their vehicles when they happen. So basically, let's say a rental car company has, a car and it gets in an accident or whatever, the rental car company will just fix up the car by themselves because they have the equipment to do so. So they don't end up like reporting or documenting that damage, and then Carvana will, swoop along, buy the car, and then since like technically on the Carfax it doesn't show that the car has been in an accident, they list it as if the car was fine, but in reality there might be some problems with it. So that's another thing, and there are some other accusations too, but those are the major two. And then the big news that we're going to be talking about today is how the father-son duo behind Carvana is buying over $500 million worth of shares of this company. So we have Ernest Garcia II and Ernest Garcia III, okay? These two have a very influential position at Carvana. Ernest Garcia III actually is the CEO of Carvana. Lately, he bought around $160 million of the stock, okay? Ernest Garcia II bought around $408 million worth of Carvana stock. These purchases happened on April 26th and April 28th. Both of their buy prices were around $80 each. And they're buying big. Insiders can sell their shares for any number of reasons. Maybe the insider wants a new mansion. Maybe they think the stock will fall. Maybe they just want to buy something else. We don't know why an insider can sell. But they buy a stock for one reason and one reason only, and that's because they think the stock will go up. That's the only reason you would buy a stock. And they're buying, and they're buying big. So when we take a deeper look at Carvana, obviously, the stock is in a giant uptrend, right? But not all stocks that end up falling end up returning back to their previous highs, as we know. So while I'm looking at Carvana, this is what I'm seeing. Clearly, the stock is extremely, extremely volatile. Over the past year, it went from 376 down to 52, actually, and it's just all over the place. Now, when we look at the company's fundamentals, we have to say it how it is. Their revenue is exploding. In 2015, they had an annual revenue of $130 million. In 2021, they had an annual revenue of $12.8 billion. That is a significant increase. And especially over the past 3 years, they've been growing like even just quicker. Like they're growing at an amazing pace. But that just because their revenue is growing, that doesn't mean you just blatantly buy the stock, because they actually lose a decent amount of money. So they are not profitable, like I said. Their cash flows are both in the negative. They are increasing their debt quite a bit. In 2015, they had gross margins of 1%, which is horrible, and now it's up to 15%, which is good. They're increasing their gross margins, which is good, but still the gross margins aren't crazy high. Their net income ratio is around like -1 to 2%. Their price to sales ratio is low. It's at 0.345, but they have low gross margins, so you need a low price to sales ratio. Their revenue is booming, which is awesome. They're not profitable, but my biggest concern out of everything for this company is how much shares they are issuing. This is very, very scary. In 2015, they had around 15 million shares outstanding, okay? Now it's all the way up to 177 million shares outstanding. The more shares they issue, the more you get diluted. So check this out. I like to use this as an example when it comes to share dilution. If we look at CGC, this company issued a ton of shares over the past 10 years. We can see this chart boomed up, and we go to CGC stock. It's been very, very bad. When companies issue shares out into the market, it raises capital for the company. If they can effectively get a great return on that capital, it can be a good thing. But if they can't, it's a really bad thing, because obviously they're just diluting all the current owners, and you own less of the company, and that's not good. However, if they could get a really, really good return on it, then that can be a different story. But normally when you see companies issuing this many shares like CGC and Carvana, it's almost always a bad thing. What you want to see, ideally, are companies like Apple. They basically buy back a ton of their shares. So not only do Apple shareholders benefit tremendously from Apple being a powerhouse company, increasing their revenue, profit, and all that stuff, dividends, but they also benefit by owning more and more of Apple every single year by not even doing anything, because Apple, the company, is buying back shares on the open market and basically burning them, so you own more and more of the company. The exact opposite thing happens when we see share dilution. So all in all, while Carvana's revenue is booming to the upside, while their gross margins are increasing, and while they're just growing a lot as a company, it's not for me right now. And the main reason is because I feel like they have some pretty big problems they have to take care of, especially everything to do with the title problem and all that stuff. But I really don't like how many shares they're issuing. That's a giant concern for me. It is awesome to see these insiders buying so much worth of the stock, but I'm not going to enter a position on this company solely because, they're plowing, $500 million into the company. That's awesome, but it's not a good enough buy signal for me. So for that reason, I'm going to stay away from Carvana, but some of you might like it for a buy play or even a short play, with the shares being diluted so much. So I wanted to share it. It's crazy news. I see both sides of the argument for people buying the stock and for people short selling the stock, because when you issue that many shares, it's not a good thing. But then again, when you have this big of a stock drop and a company is growing as fast as Carvana, it's not the worst thing in the world to maybe sell puts on, considering how high implied volatility is. So feel free to check out Carvana. It's a crazy company. And if you want to analyze any company like I analyzed Carvana today, make sure to check out that first link in the description and the comments down below. Now is the best time to analyze companies' fundamentals because there are so many discounts out in the market right now. You'll be able to know basically instantly whether a company is worth buying or not. So definitely check it out. First link in the description and the comments down below. Besides that, let's have a great week.